I now want to turn to what might happen in 2021 and how do you protect your portfolios. So how will you protect your portfolio in 2021 and 2022? So 2020, obviously a very exceptional year, and 2021 hopefully will become a bit more normal. But the market's focus is going to be on 2022. The market's going to look forward when things should be back to normal. And valuations should reflect that expectation. So what you need to do as a stock market investor is compare 2022 with 2019. Now, obviously, some companies will be reporting higher profits, lots of tech stocks, notably, and some companies will be reporting lower profits because some of the travel businesses may not see a full recovery, and obviously they'll be carrying a lot more debt. That's obvious, right? Everybody can work that out. But your job as an investor is to work out where that's not priced in. And how do you do that? How do you identify where it's not priced in? Tech's broadly priced in a large part of the growth, most tech stocks. Value's only started to bounce back, and it's value which is so depressed. And value is where the value is to be found. I know that sounds silly, but I'm sure you understand what I mean. Value always does better coming out of a recession because growth isn't scarce. Growth does better when growth is scarcer. When you're coming out of a recession, there's growth everywhere, and value is cheaper. So value tends to do better. And partly that's because the market underestimates the recovery potential. But COVID is very, very different. We're not exiting a normal recession. COVID creates a very different scenario because some sectors have been incredibly hard hit. Their share prices have collapsed, but the valuations haven't. The cruise stocks are a great example of this. Look at Carnival. The share price chart, as you can see in the right, the share price has collapsed. But the valuation hasn't. The enterprise value today isn't a long way different from what it was before we entered COVID. So the total value of the business hasn't moved very much. But we know that its prospects are going to be colored by COVID for some time. I mean, maybe there'll be some pent-up demand and a lot more people will go cruising. Maybe there'll be less cruise ships around. But it's carrying a lot more debt. So don't be fooled by that collapse in the share price into thinking there's a great opportunity here. And many bombed out share prices disguise a much smaller move in the enterprise value. And I think you should steer clear of these situations because there remains a lot of risk. Look for stocks where things will be back to normal, but the competitive landscape has changed and profit opportunities have increased. A good example is industries where there's a lot of mom and pop presence, which have been badly hit by the pandemic. The great example of this is the casual dining sector. Lots of restaurants will sadly have closed. There'll be some where the proprietor has just got fed up. They're older and they just decided to retire. There'll be some, sadly, where the proprietor hasn't been able to cope, hasn't had sufficient financial balance, hasn't had enough cash to stick it out through this pandemic because it's been a long, drawn-out process for many restaurateurs. What that means is that those that remain will benefit because there'll be less supply. People will go back to eating out again. And although you shouldn't necessarily assume that revenues for the sector as a whole will be higher in 22 than 2019, because there may be some lasting impact. Lower paid people may just not be able to afford to go out to eat. Unemployed people may not be able to afford to, and not counterbalanced by rich eating out more. But the supply will be smaller. And the people that are left, the restaurants that are left, will grab a greater share of the pie, and they will probably see revenues rise. And the other thing to think about is look for stocks where things have got back to normal, the competitive landscape's changed because of bankruptcies. Now, this is also true for the casual dining sector because we've seen a load of chains going bust, particularly in the UK. But the example, I think, the better example here is the UK retail sector. We've seen a string of bankruptcies in the UK, Arcadia, Debenhams being two of the highest profile. Next, still there, less competitors. It also has the advantage that it's developing a business like Amazon's business, where it services other retailers. So other retailers can use Nix's platform to reach customers via the internet and Nix logistics solutions. That could be a big business for Nix. The stock has bounced quite well, so there's not as much obvious value on offer. But I think this is the pattern to look for. And the thing to focus on is the supply, not the demand. And this just shows you that Nix, the share price has done extremely well. So it's clearly not a bargain basement. And you can see in table there that the analysts are forecasting a big bounce back in revenue. And even then, it's not obviously cheap relative to history. But Nix looks to me a very interesting situation. So I hope you've enjoyed this. I hope you found it useful. And there are more videos like this in my website, in the free training area in our club website. You need to sign up, but we'd love to have you there.